Hello, everybody. Welcome to Daniel Coogan Associates Market Update for October 2024. My name is Rocky Istvan. I'm the Chief Compliance Officer and Associate Wealth Manager at Daniel Coogan Associates. We normally are recording our live workshop for October, but we ran into a little bit of a glitch. Some of the material we are presenting has republication restrictions, and we didn't receive the permission we needed as of yet to be able to republish it. So that's why we couldn't record it and make it available to you. So what we're going to do is include in this email, you'll have a website address that you can go click on that and learn a lot about some of the research that's going on with the technologies such as artificial intelligence, the Web3, robotics, and all this disruptive technology that is coming and that we're looking at for investing in the future. So we apologize that the full presentation won't be available, but if you're interested, go check out some of the research that's associated with this, and I think you'll find it very, very interesting. So let's move on. Let's talk a little bit about the markets for this October of 2024. So first thing, we want to thank CNR for their research and materials that I'm presenting today. But let's start out with a kind of an overview of what the year-to-date looks like. When we look at the S&P 500, it is actually up 22.2% as of October 16th. The bond market, actually it's still up, but it has retraced a little bit in the last month. So what we're seeing is that the lower than expected volatility in the equity markets, which we kind of expected going into an election season, hasn't come about. We're actually having a very strong end of third quarter into fourth quarter. And actually some analysts are revising their year-end market forecasts upwards. The aggregate bond index has, like I said, moved down almost 1% since the middle of September. And that's mainly a result of the hotter than expected inflation numbers, which came in here just the last couple of weeks, which raises the possibility of less rate cutting by the Feds in the next months or slowing down a little bit. We still think there's going to be rate cuts, but it's making them be a little bit more cautious. Also, lower money market rates as a result of the first rate cut we've had from the Fed are starting to motivate investors into looking at other alternatives in the fixed income and bond markets for longer duration as a hedge to the continued expected lower rates that are coming in the future. When we look at things by sector in the S&P 500, it's been the story for the last 12 to 15 months. Actually, technology is leading the way, but you can see that financial services has really played a big role in the growth this year. Communication services has played a big role. And even things that really were lagging, like real estate and energy, have rebounded really strongly in the last 3 to 6 months. So across all the sectors of the S&P, we are starting to see that broadening of the market, improvement of the growth taking place in the value in the S&P 500. When we talk about the economy, we've got our latest economic speedometers here from October, and the places that are circled, the dials that are squared with the green squares, are indicating where we're still continuing to see positive movement. Monetary policy, top left corner, is continuing to improve as we believe rate cuts are going to continue to come, which has caused the yield curve to also start to improve. Now, it's not completely a positive, but at the beginning of the year, it actually was red. So this is a big movement forward. Also, interest rates, we believe, are going to continue to come down. The business outlook is continuing to improve. The rest of the sectors and speedometers are holding their own. And obviously, the two areas that are red still is geopolitical risk and equity market valuation. The reason equity market valuation is in the red is just because we are at market highs. We've actually hit several market highs in the last month and a half, and that means prices are up in equities. But when we look back at January on the right side of the screen, you can see that even though the economy's slowing, there's lots of signs of improvement for the future economic indicators going into the next 6, 9, and 12 months. When we look at some of our forecasting from CNR, we can see that GDP growth, the top line there, is moderating. We were at 2.5% growth in 2023. We're expecting that to slow down to somewhere around 2% and be in that 2% range going through next year. Corporate profits are expected to show improvement, though, going forward into next year. And that's one of the reasons we're seeing improved values on the S&P 500. Inflation pressures are expected to continue to moderate. Again, when prices start coming down and inflation is slowing, it's not necessarily across the board, and it's not always a smooth ride. So we're kind of seeing a little bit of movement up and down, a little bit of volatility. But overall, inflation is slowing, and that's what we need for future growth in the economy. We do expect the Fed's fund rate to be down somewhere from 3/4 of a point to a full point by the end of the year. And we expect it to go down a little further through 2025, which will bode well for long-term investors. And finally, the Treasury notes, we're seeing stabilizing there. We're kind of seeing some firming up there. Maybe not going to be as aggressive as we had hoped. Maybe, somewhere between 3.75% to 4.25% yields on 10-year Treasuries, and then stabilizing somewhere in that range throughout 2025. We haven't showed this before, but I think this is a good time to bring this chart in and discuss it a little bit. Basically, what this measures is what are the financial conditions that are a headwind to growth, which is negative if it's a headwind, or those things that could be a tailwind to growth. So it's kind of an inverse relationship chart. And as you can see in this, whenever it spikes up, that means there's a lot of things in the financial conditions that would say, hey, things don't look good going forward, versus tailwinds, which are positives. And as you can see towards the right side of the chart, coming out of COVID, which is between that 2020 and 2022 mark, where we had a high tailwind. Why did we have that? Because of all the stimulus that was put out there. Government was worried about things slowing down too much, put money out there for people to spend. Interest rates are at zero, so it was easy to borrow. But since then, the result of a lot of printing of money and economic improvement really fast, inflation kicked in. And that's why you see this spike going on in 2022 and 2023. So that was a pretty high level. We hadn't seen anything near that high since 2008 as far as headwinds to growth. But look where we're at now. Things have stabilized, come down significantly, and we think we're going to continue to see improvement towards tailwinds to growth in the economy moving forward. So let's just talk about some key takeaways without going into a lot of charts, just to summarize where we are watching things moving forward towards the end of the year is what's going on with monetary policy. Are we continuing to see the Fed consistently lower rates over time because they believe that inflation is under control? What's going on in the housing market? Where is unemployment at? And where are the interest rates at? All those things are going to spur or hinder the growth moving forward. But those are the key areas we're monitoring. The Federal Reserve is likely to reduce rates. We're hoping another 0.5% by the end of the year, and we expect that to continue, although maybe not be quite as much because of the strong economy that we're having right now. Election years usually experience declines. That's what we're kind of anticipating in a run-up to the election, but we really haven't seen that. So for people that are wanting to do Roth conversions, and we were looking for that dip or to get into some reallocation into some new markets or new sectors, the market has stayed strong. So we really haven't seen that. So we're going to tend to start pulling the trigger on those activities anyways, as we've seen the economists and the analysts raising their expectation for the end of the year. Party control of the presidency does not dictate the direction of stocks. We can look at that throughout history, and no matter what you hear on the news, the tendency is when the economy's strong, the markets will stay up and be strong. And that's what we're seeing now. We're seeing strength in the economy and its direction moving forward. Concerns have surfaced on the sustainability of AI. We saw the big run up in the tech stocks in 2023, although we saw a steep decline in them in 2022 when the market took a big hit. But we believe that we are still in the early phase, so the volatility is going to be there. But for the long term, we believe in technology that is being developed and where the investments will be placed and the return on those investments will come to fruition. So we don't want to ignore the tech sector, even though we feel that it's been volatile and speculative. It needs to be a little bit part of most portfolios out there. Also, despite attractive valuations on the international markets, they still are not performing at the level that the US has performed. So we have not really jumped in and reallocated internationally at this point. So, but it is something we are watching. If things continue to stay a little slower than history of the last couple of years in the US, we might look for opportunistic purchases overseas and in stocks and in solid companies over there. And finally, the financial conditions, as I showed on that last slide, are very supportive of continued expansion. We believe there's less headwinds and more tailwinds moving forward going into 2025. So just to recap, we are seeing something a little different this October than what we've seen in past presidential election years. We're not getting that dip going into it, not really anticipating it either. So we are repositioning portfolios and going to take advantage of what we believe will be a market that's going to be higher at the end of this year than it is now. Also a reminder that check this email that you got this video link in for the research website on some of the technology that was presented in our live workshop. And from there, I'm just going to close with, if you want to watch any of our past videos and market updates, they're available. You go to our website to the Watch Us section and DK&A YouTube, and you'll find all of our educational and other videos out there for Daniel Krug and Associates. So I hope this was helpful to you guys. There's no need to worry. We're ready for 2024 and beyond. Enjoy your day and good seeing you. Thanks.